Hey everyone, welcome back to Corporate Dakota, where we shine a light on the often murky world of corporate finance. And today we are diving into a very interesting set of reports from Fidelity COVINGTON Trust covering several of their ETFs. So buckle up because we are going to decode what these numbers really mean for investors. Alright, we are looking at the semi-annual shareholder reports for a group of Fidelity ETFs as of the 30th of November 2025. These reports give us a snapshot of how these funds are performing and what they are invested in. Now usually, these reports can be dense with jargon, but our goal today is to cut through that and understand the real story behind the numbers. Let's start by getting a quick lay of the land with some key facts. For example, the Fidelity Disruptive Technology ETF had a fund size of $192,018,739. That is a pretty significant chunk of change. But what is really interesting is how these funds are structured. Many of them are essentially investing in other Fidelity ETFs, for instance. The main Fidelity Disruptors ETF is investing in Fidelity Disruptive Communications ETF, Fidelity Disruptive Finance ETF, Fidelity Disruptive Medicine ETF, Fidelity Disruptive Technology ETF, and Fidelity Disruptive Automation ETF. Let's dig into the Fidelity Disruptive Technology ETF. As of the 30th of November 2025, its portfolio was heavily weighted towards information technology, making up 77.2% of its net assets. Within that, semiconductors and semiconductor equipment was a big chunk, but it also had exposure to countries like Taiwan and the Netherlands. Some of its top holdings included familiar names like Nvidia Corp at 6.7% and Taiwan Semiconductor Manufacturing Co. Ltd. ADR at 6.6%. This tells us this fund is very focused on the tech giants driving innovation. Now let's look at the Fidelity Disruptive Automation ETF. Its focus is more on industrials at 52.2% and information technology at 35.4%. This fund is investing in companies that are making the machines and software that automate industries. Geographically, the United States is its largest exposure at 54.2%, but it also has a notable stake in Japan at 15.8%. Top holdings here include Taiwan Semiconductor Manufacturing Co. Ltd. at 6.5%, Teradyne Inc. at 5.5%, and Nvidia Corp. Again at 4.7%. It is interesting to see these ETFs overlapping in their top holdings, which is normal for sector-focused funds. Moving on to the Fidelity Disruptive Communications ETF. This one is focused on communication services at 51.8% and information technology at 32.6%. Its top holdings show a clear bet on the digital communication space with Alphabet Inc. Class A at 8.2%. Taiwan Semiconductor Manufacturing Co. Ltd. ADR at 7.8%, and Meta Platforms Inc. Class A at 6.4%. Geographically, the United States is its stronghold at 75.1%, followed by Taiwan and China. Then we have the Fidelity Disruptive Finance ETF. This fund is heavily concentrated in financials at a striking 89.8%. It is investing in companies that are changing how we handle money and finance. The United States is its largest market at 67.2%, with the United Kingdom and Netherlands also significant. Top holdings include Capital One Financial Corp at 6.2%, BlackRock Inc. at 5.4%, and Block Inc. Class A at 4.8%. Finally, the Fidelity Disruptive Medicine ETF is almost entirely dedicated to healthcare at 99.9%. This fund is all about companies pushing the boundaries in medical research and technology. The US makes up a huge 83.5% of its portfolio. Some of its top names are Exact Sciences Corp. At 5.0%, Boston Scientific Corp. At 4.6%, and Argenx SEADR at 4.4%. Let's dive a bit deeper into the financials of one of these, the Fidelity Disruptive Technology ETF. For the 6 months ended the 30th of November 2025, the net asset value per S-share was $40.1. Looking at the total return for this period, it was 13.46%. This means if you had invested $10,000, your investment would have grown by about $1,346 over those 6 months. The expense ratio before reductions was 0.50% and after reductions remained at 0.50%. This is pretty standard for an ETF like this. Now for the Fidelity Disruptive Communications ETF, also for the 6 months ended the 30th of November 2025, the net asset value per S-share was $47.13. Its total return for that period was a more impressive 16.54%. Consider this, a $10,000 investment would have gained roughly $1,654 over those 6 months. Interestingly, the expense ratio here was also 0.50%. However, one notable factor is the net investment income loss. For this 6-month period, it reported a loss of $61,295. This suggests that the income generated from dividends and interest was less than the expenses incurred. Turning to the Fidelity Disruptive Finance ETF, the net asset value per S-share as of the 30th of November 2025 was $34.87. This fund actually saw a negative total return of 5.81% for the 6-month period. This means that $10,000 invested would have dipped by about $581. Its expense ratio was 0.50% and it showed a positive net investment income of $206,316. This positive income is good, but it was overshadowed by losses in its investments. For the Fidelity Disruptive Medicine ETF, the net asset value per S-share was $28.66. This fund had a very strong total return of 22.72% for the period. A $10,000 investment here would have grown by approximately $2,272. The expense ratio was 0.50%, but this fund reported a net investment income loss of $98,685. This loss in investment income was clearly more than offset by strong gains in the value of its holdings, highlighting the high growth potential and also the associated risks in the healthcare sector. Back to the Fidelity Disruptive Technology ETF, the net asset value per S-share was $40.1. For the 6 months ended the 30th of November 2025, its total return was 13.04%. The expense ratio was 0.50%. However, this fund reported a notable net investment income loss of $195,551. This shows that even with strong overall performance driven by capital appreciation, the fund's operating expenses and other costs outstripped its income generation from dividends and interest. Now, let's touch on something fundamental about these funds. They are structured as a fund of funds. This means that instead of buying individual stocks and bonds directly, the Fidelity Disruptors ETF primarily invests in other Fidelity ETFs. This creates a layered structure where you are essentially paying fees at multiple levels. The report mentions this structure and clarifies that each fund is a non-diversified fund, with the exception of Fidelity Disruptive Medicine ETF. This means they can be more concentrated in fewer holdings, which can lead to higher risk and higher reward. When we look at how these funds value their investments, it's interesting to see how they categorize their assets into level 1, level 2, and level 3 inputs. For these particular ETFs, the vast majority of their investments, specifically common stocks and money market funds, are categorized as level 1. Level 1 means they are valued using unadjusted quoted prices in active markets for identical investments. This is generally considered the most reliable method because it reflects real-time market prices. The fact that these ETFs have almost all their assets in level 1 categories suggests they are heavily invested in liquid, publicly traded securities. A key point highlighted in the reports is related to fees, particularly the management fee. For most of these ETFs, including Fidelity Disruptive Technology ETF, Fidelity Disruptive Communications ETF, Fidelity Disruptive Finance ETF, Fidelity Disruptive Medicine ETF, and Fidelity Disruptive Automation ETF, the management fee rate is set at 0.50%. The reports also detail brokerage commissions paid to affiliated firms. For example, the Fidelity Disruptive Automation ETF paid $441 in brokerage commissions to affiliated firms, and the Fidelity Disruptive Technology ETF paid $130. While these amounts might seem small in the grand scheme of billions in assets, it is important to note that these are transactions with related parties, and transparency here is crucial. Another interesting aspect is the security lending activities. These funds lend out their portfolio securities to earn additional income. For instance, the Fidelity Disruptive Communications ETF has collateral on securities loaned amounting to $735,900. The reports also detail fees paid to lending agents like National Financial Services, an affiliate of the investment advisor. For example, Fidelity Disruptive Automation ETF paid $4,291 in total security lending fees to NFS. This diversification of income streams is a common practice for ETFs to try and boost returns. Let's circle back to the main Fidelity Disruptors ETF. This fund acts as a sort of umbrella, investing in the other specialized disruptive ETFs. Its total investment in securities as of the 30th of November 2025 was $101,420,915. It is primarily invested in domestic equity funds at 80.8%, which are these other Fidelity Disruptive ETFs. International equity funds make up 19.1%, and these are primarily the Fidelity Disruptive Automation ETF. This fund structure shows a clear strategy of aggregating specialized disruptive themes into one offering. Looking at the asset allocation for the Fidelity Disruptors ETF, we see 80.8% in domestic equity funds, which are other ETFs in the Fidelity lineup, and 19.1% in international equity funds, which is largely the Fidelity Disruptive Automation ETF. This confirms it is a fund of funds strategy. For the Fidelity Disruptors ETF, the net asset value per S-Hair at the end of the period was $35.64. The total return for the 6 months ended the 30th of November 2025 was 11.78%. This means a $10,000 investment would have grown by about $1,178. The expense ratio before and after reductions was listed as 0%, which is quite striking and suggests a fee waiver or reimbursement is in place for this particular ETF. This is a significant benefit for investors as it means more of the potential gains are retained within the fund. So what is the big picture here? These Fidelity ETFs offer focused exposure to disruptive themes like technology, communication, finance, medicine, and automation. The fund of funds structure, particularly for the main Disruptors ETF, is a way to offer diversification across these themes, but also introduces layers of fees and complexity. While many of these funds saw strong positive returns and growth in assets, it is crucial for investors to understand that their performance is tied to volatile and innovation-driven sectors. The fact that some funds like Fidelity Disruptive Communications ETF and Fidelity Disruptive Technology ETF reported net investment income losses, even while their overall value grew, highlights that capital appreciation is the primary driver of their returns. The Fidelity Disruptors ETF, with its zero expense ratio for the period, is particularly attractive from a cost perspective, but investors should always be aware of the underlying costs of the ETFs it holds. Alright, that is our deep dive into these Fidelity ETF reports. What is your take on these disruptive funds and their strategies? Do you think this fund of funds approach is smart or a bit too complex? Let me know your thoughts in the comments below. If you found this analysis helpful, please hit that like button and subscribe for more. And don't forget to join our Discord community linked in the description for even more insights and discussions. Thanks for watching, and we'll see you next time on Corporate Decoder.